Hello, students, and welcome to the second half of the Investment Funds of Canada course. This chapter is getting kind of right into the definition of what this course is about, which is a deep dive into what a mutual fund actually is. So, Chapter 10, the modern mutual fund. So, as we've discussed before, what is a mutual fund? A mutual fund is a single investment vehicle that pools small contributions from many different investors. It invests in a diversified portfolio, meaning a multitude of different stocks, bonds, and money market funds. That mutual fund might hold all stocks, it might hold all bonds, it might hold all money market instruments, or it might own a piece or a portion of all three of those in one single mutual fund. Investors own units or shares, and a share either and shares in the gains, the losses, and the expenses in proportion to their holdings. So, the more of a single mutual fund that a person holds, the more they will realize the gains, but also the losses and the expenses. Units are bought and sold at what's called net asset value per unit, NAV/PU, or per share, NAV per share. We'll get into those two terms in just a moment. So, what are some of the advantages to using mutual funds or holding mutual funds in comparison to other investment vehicles? While they are professionally managed, you have someone with a lot of experience and education behind them, making the decisions on a daily basis. Mutual funds are well diversified, as they don't simply hold one stock or one bond inside of the mutual fund. They hold many of them. It's a way to automatically diversify by holding one single mutual fund. There are a wide variety of funds, many different types and specialties to choose from. Mutual funds are liquid, meaning that you can at any point in time liquidate or sell off the units of a mutual fund that you hold in order to have cash instead of the investment. There's transferability of a mutual fund. They can be transferred from one person to another and from one institution to another very easily. They are tax efficient from an estate planning standpoint. And I would say probably from an accounting standpoint as well. If you think about what is required to be used and supplied to CRA when filing taxes, if you held hundreds of individual stocks, you would have to supply and track hundreds of different purchase prices and costs, whereas owning one single mutual fund that then holds many investments, you're only responsible to track and to claim that one mutual fund. A mutual fund can also be used as loan collateral, meaning that you can borrow against the value that you hold in a mutual fund. Again, there are definitely some limitations and some rules behind that, but it is possible. In your spare time, if you want, CEDAR is access to public documents for mutual funds. Go take a look at that website. It can be very useful and educational. What are some of the disadvantages of mutual funds? Nothing is perfect. Nothing is the absolute best selection or best choice. Mutual funds have positives. They also have negatives. So some of the disadvantages of mutual funds. There is a cost associated to mutual funds. There are fees, MERs. We'll get into those in a little bit, but MER stands for Management Expense Ratio. That is typically a percentage cost that is charged for holding mutual funds. They're not ideal for short-term or emergency funds. Typically, mutual funds are more for long-term investing. Managers may still make poor investment decisions. So even though you have an investment vehicle that is professionally managed, it's still a person that can make good and bad choices. So that is a risk. And tax complexity for investors. So although in my last slide I mentioned that it can be simpler than holding a multitude of different investments, the complexity of how and why things are charged or are taxed can be a little bit more difficult to understand, even though it's all the taxes from maybe a single holding like a mutual fund. We'll get into some of that a little bit later as well. So structures. There are two different ways a mutual fund can exist or can be structured. It can be structured either as a trust or as a corporation. The majority of mutual funds that exist, especially in today's market, are mutual fund trust structures. In trusts, the income flows to unit holders. It is taxed only at the investor level, net of fees and losses, and it avoids getting taxed at the fund level. So the trust itself, if the mutual fund is structured that way, the mutual fund trust is not responsible for taxes that are created from the buying and selling of the units. They would pass that, of the stocks held in the fund, they would pass that taxation back on to the trust unit holders. Conversely, mutual funds can, although not often, be structured like a corporation. So a mutual fund corporation. They're set up federally or provincially. They're eligible for tax benefits if diversified, but the income tax is taxed within the fund itself before gains or income would be then sent to holders of the mutual fund. So a very different structure. Typically, the most of the ones you will see and have heard of in the marketplace today would be structured as mutual fund trusts. Excuse me. Now, I'm going to get back to that slide in a bit. It's in the wrong order. So, mutual funds and responsibilities. So, there are different people responsible for different things within a mutual fund. One role, we'll go through some of the different roles. So, the trustee or directors of a mutual fund, they're legally accountable for fund compliance. The fund manager is the one that supervises the portfolio, responsible for the perspective, for calculating NAV, for fund facts and tax reporting. We'll get into a few of those definitions in just a couple slides. The custodian for the mutual fund is the one that actually holds the fund assets and confirms ownership. The distributors for the mutual funds are the ones that sell fund units. So if you worked for Bank of Montreal and sold Bank of Montreal mutual funds, you would be a distributor for them. And then there is the Independent Review Committee. They ensure conflicts of interest are properly managed. You'll see underneath it lists NI 81107. That is a national instrument rule. We'll get into those as well in just a couple of screens here. So mutual fund regulation. There's a lot of rules everyone has to follow in order to be involved in the mutual fund industry in Canada. Canada, because it is a large country built with provinces and smaller jurisdictions, there are different levels of regulation in Canada. Each province in Canada is responsible for regulation via their Securities Commission. So, for example, in Alberta here, we have the Alberta Securities Commission. In Ontario, they would have the Ontario Securities Commission. In BC, you would have the BC Securities Commission. So that's one layer of regulation in the mutual fund and investment industry. Then the next level are what we call self-regulatory organizations, and they would be countrywide. Two of the groups would be the MFDA, the Mutual Fund Dealers Association, and IIROC or IROC for investment dealers. So those two groups have actually been amalgamated, and I will add a another link and slide with some additional information of what has happened since the MFDA and IROC have merged under one umbrella. But for the examination, please remember what is listed in your textbook is what you're responsible for studying. So those are the two areas that are the two levels of regulation in Canada. The core regulatory principles that everyone must follow is that there must be personal trust, there must be disclosure, and there must be regulation. Those are the three core regulatory principles that every organization would fall back on to ensure that rules or that the industry is performing the way it should be. So again, NIs or national instruments. So in Canada, key national instruments related to investors are written by the Canadian Securities Administrators, or the CSA. So we just on the last screen, we talked about how there were provincial regulators and then there were self-regulatory organizations. There is also an umbrella group called the Canadian Securities Administrators. They're really, like the description says, an umbrella organization that gets all the different provincial regulators together to come up with instruments, national instruments that apply across the whole country. So again, the CSA acts as an umbrella to gather up all the provincial regulators, including the Alberta Commission, to agree on these national instruments. I would highly recommend you go through these 6 national instruments and understand them. Here, I'm simply going to briefly discuss what the main point is of each one, but I would recommend going into a little more detail into your textbook to be a little more familiar. So NI 81-101 covers the prospectus form and the content. National Instrument 81-102 is creation, distribution, and advertising regarding mutual funds. NI 81-103 deals with conflicts, insurance, capital, and conduct, again relating to mutual funds. NI 81-105 deals with sales practices and compensation of mutual funds. NI 81-106 covers continuous disclosure surrounding mutual funds. And finally, NI 81-107 covers the Independent Review Committee, or the IRC, in regards to mutual funds. Again, that is the main coverage. I would recommend knowing them by number, by name, and by definition a little bit more than what I've covered here, but I'm not going to take the time during our short periods to go into more detail. Simply know what the coverage is and understand it. So, disclosure. There are disclosure documents that if you are selling a mutual fund to a client, that have to be available and or provided. So the first is what we call the fund facts document. It is a plain language summary of the mutual fund, a maximum of 4 pages, double-sided, must be delivered to a client who is purchasing this mutual fund within 2 business days, and is made up of 2 different sections. Section 1 is information about the fund, things like the fund manager, the fund name, the fund manager, different classes that exist within the fund, some quick facts about that fund, the cost, again, the manager, potentially a minimum investment that's required. The next piece of information in section 1 would be the investments, whether its risk is low, medium, or high, and past performance would be listed. There'd be a description of suitability, who would be suitable, what type of person, what type of risk, what type of investor profile should be using this mutual fund, and then tax implications. Those will all be listed in section 1 of the fund fact document. Section 2 of the fund fact document would go into the costs, rights, and other information. Things like sales charges, fund fees, trading or switch fees, the rates of withdrawal and rescission, which we will talk about in a minute, and then how to get more info, where a purchaser could look or go to for additional information over and above what's listed in the fun facts document. Again, fun fact typically delivered when you're face-to-face with a client, delivered in person at the time of purchase, and you'll be reviewing that document with the client. The next type of disclosure document would be a simplified prospectus. This is required by law to be produced and to be filed annually, so a new one would be created every single year. It's only provided to a purchaser or to the public on request. It is a much, much, much more detailed description of the mutual fund. It would have two parts, part A and B. Part A would again be the general info about the mutual fund and the fund company, and part B would be the specific details for each fund: the risk, the charges, the fees, the distributions, legal info, auditors. Again, if you think about the fun fact, it is a quick description, summary. I would call it the summary document for the mutual fund. The simplified prospectus would be the detailed summary of the investment mutual fund. And then the last, or they call it C for the third document required to be produced for a mutual fund, is the annual information form. It adds additional detail over and above the simplified prospectus. It would discuss significant holdings in other issuers. It would discuss tax status, potentially officers and directors, changes of officers and directors, compensation and ownership, and any material contracts and or material changes that would be changed from when the prospectus was filed. So again, think of the fun fact as a summary. Think of the prospectus being the detailed summary, and think of the annual information form being kind of like an addendum or an add-on to the prospectus. So when we talk about the value of a mutual fund, or what is the current value, say, of a specific fund, we're talking about the NAV/PU, meaning the net asset value per unit. It's the way we price an existing mutual fund. When you're buying or selling a mutual fund, we're executing that at the next available NAV. So mutual funds only get valuated once a day. It's basically at the end of business day. And you'll be using that end of business day value to complete a purchase or a sell on the following day. So if someone were to come to my office to buy a specific mutual fund today, and it was before market closed, we would enter the purchase for that specific mutual fund. We wouldn't know the price at that time because they would be getting the price as of the close of business day, which basically is being entered first thing tomorrow morning at the close of today's price for that mutual fund. Mutual funds don't trade live throughout the day. They basically are all valuated, purchases and sales done at the end of business day to be completed the following day. How do we calculate what NAV is? It's basically the formula of assets minus liabilities divided by the number of outstanding units. So an example is if you had a mutual fund that held assets worth $4,500,000 that had liabilities of $250,000 and units outstanding of $1,500,000, the calculation would be $4,500,000 minus $250,000 divided by $1,500,000. That looks like that text I've got there doesn't show up very well, but the answer to that would be $2.83. So it would be $2.83 would be the NAV per unit, the net asset value per unit for that mutual fund. Again, we don't normally necessarily calculate that ourselves. That's always calculated for us via technology, but you need to know how and why for the exam. So mutual fund performance and fees. We have to use a specific method of reporting performance on a mutual fund, and that is regulated via the National Instrument 81-102. It states that we need to report for a 1, 3, 5, and 10-year rate of return, as well as when we're calculating the return, we have to do it on a compounded basis, except for money market funds, which is basically almost a cash position. So again, because of National Instrument 81-102, we have certain standards and ways of reporting return. It means we have to report 1, 3, 5, and 10-year returns, as well as using a compound return formula. That has to do with performance. Now, having to do with expenses. The primary expense of a mutual fund is considered to be the MER, or the Management Expense Ratio. It is a percentage that is charged against the fund, or reduces the value of the fund by the cost. So what's the formula for MER? It basically is the annual fees and expenses, including taxes, divided by the daily average net asset value. So an example of that would be if we had fees and expenses of $276,000, but an average net assets of $11,650,000, the MER would be $276,000 divided by $11,650,000, giving us 2.37%. So that would tell us, and we would have to disclose, that the MER, or the cost, the management expense ratio of this mutual fund is 2.37%. So if a mutual fund earned a 5% return, but had a charge of 2.37%, the actual investor's return would only be 2.63%. Now, having said that, we always have to advertise fees after MERs are already accounted for, so we're not hiding that. Know that. But we would also have to disclose that 2.37% is the cost that is being charged to a client in order to manage the mutual fund. We have to pay managers, we have to pay directors, we have to pay for administration, we have to pay for purchases and sales of the instruments that are held in the mutual fund. All those costs are charged via a percentage, typically a fixed percentage. It would be listed on a fund fact and in the prospectus, and you would disclose that to a client prior to selling them a mutual fund. So clients have 3 different rights when it comes to a purchase of a mutual fund. The first right they have is the right of withdrawal. What this is they have 2 business days after receiving the fund facts or the simplified prospectus for a full refund. If you give the client the fund fact at the time of purchase, they basically have 2 business days from that point to simply ask for a full refund, because they've now had time to review the information and make a decision after the fact. Then there's the right of rescission. If a client feels that there is misleading info found in a document, the client can cancel and receive the NAV and fees. It's basically the right to cancel as well. Then there's the right after confirmation slip. So 2 days after a client receives a confirmation that the mutual fund purchase has taken place, they can receive the value at day of cancellation plus fees. So again, 3 different ways to cancel. Know the difference, because it's definitely may be on your exam. So again, the key takeaways from this chapter: understand what a mutual fund fee structure is, the trust versus the corporation, what the differences are. Know the different roles of trustees, managers, custodians, and distributors. Memorize, again, memorize the regulations and the NIs, the national instruments. Be able to calculate a simple calculation of NAV and MER. Know disclosure rules, specifically fund fact delivery and simplified prospectus, and understand clients' rights, the withdrawal and the rescission. Right? Don't forget, like always, ensure that you have reviewed the entire chapter and all of that information is testable on the final exam. Thanks.